What if I told you we are about to enter potentially the worst economic crash our country has ever seen? Scenarios that can make the Great Depression look like a small pinch compared to a massive punch to the face. But what if I also told you time and time again, even going back 100 years, there's always been a small percentage of people who not only survived during the economic crash, but also thrived. Even if you look at men like Mark Cuban, Sam Zell, Barry Sternlicht, one thing they all have in common is that they made a majority of their wealth not because of good economic times, but actually because of economic crashes. Now, being a billionaire might not be the goal for every single one of you, but those guys all use the same principles and tactics that the small percentage of people use throughout the years to survive and thrive. And those principles, well, that's what we'll be discussing in today's video, answering the question, what do the wealthy do to prepare for the economic crash, and how can we do the same? Now, in even answering this question for myself, I spent countless hours throughout many years conducting research, having conversations with experts in investing and finance, and honestly observing what seems to work and what doesn't work. And as the hours and the years went on, well, I noticed that there are 3 things that the wealthy tend to do to prepare for an economic crash that others don't even think about. So with that said, let's go ahead and begin with number 1, which is to liquidate and pay off debt that are attached to liabilities. Now, historically speaking, one of the things that tend to rise right before a major economic crash is the amount of expenses that the average American household is responsible for. In fact, CNBC reported that currently in 2022, the American household is paying on average an extra $327 a month in expenses. On top of that, Fortune estimated a 6% increase compared to last year in our monthly bills. Now, here's why that matters significantly. Because typically, as monthly spending for the average American household increases, it tends to lower consumer spending, which leads to a lot of business revenues starting to slow down. And once that starts to happen, it begins affecting the markets, and that's when the real cost for any economic downturn kicks in, which that, my friends, is fear. You see, the media starts releasing headlines and news reports stating that the markets are down and a recession may be around the corner, and everyone starts holding on to cash, and mobility in the whole financial system begins to stale. But in going back to paying off debt attached to liabilities, in order for us to survive and thrive during an economic crash, we want to ensure that we're free of any debt liabilities, especially the ones that cost us the most in interest on a monthly basis. Because at the end of the day, that's money that should be going into our pockets, but instead is going into the profit category of the big banks. Now, I'm sure at this point, many of you may think, great idea, Daniel, especially if you want to write me a check for $100,000 so you can pay off all of my debt for me. Well, as much as my name isn't Bernie Sanders, and as tempting it is for me to do that, I can at least do something close to that, which I'll bring up at the end of the video. Because for the most part, paying off debt using straight cash isn't necessarily the most wise financial decision. In fact, there are other vehicles that the wealthy will use to pay off their debt that's far more efficient than cash. Now, regardless, at the end of the day, the goal, especially right now at this time in the market, is to pay off that high interest debt that eliminates a bulk of our monthly expenses right now. This is what allows us to increase our net monthly cash flow, which is a number that I notice the wealthy tend to obsess over. In addition to paying off debt, the wealthy also tend to accumulate a decent amount of liquidity in preparation for a crash, mainly centered around 2 big reasons. The first being the purpose of an emergency fund in case some of their income streams start to decrease, and number 2, which is the most important one, they want to have enough liquidity to buy any assets at a discounted rate. To give you an idea, in 2008, stock prices fell on average 50% as a result of the 2008 crash. Commercial real estate properties fell 27% in value, and single-family housing prices fell 16%. Now, with that, of course, the question then becomes, well, what is the best thing for us to do with all this liquidity? And that leads us to point number 2, which is to get involved with cash flowing real estate. Now, first and foremost, I want to address the big elephant in the room. A lot of YouTubers recently have been talking about how the housing market is about to crash and that real estate might not be the best investment to get involved with right now. And yes, I would agree with them that the housing market is very well on the verge of a crash. However, with all due respect to them, YouTube, as many of you may be already aware, is actually my second job. My first job is actually a full-time real estate entrepreneur, and by the time I was 23, I had about $10 million worth of real estate assets under my belt. And from my perspective, along with other investors who have hundreds, if not thousands of rental units units in their portfolio, you're already breaking the first cardinal sin of real estate investing if you're looking at it from the perspective of not buying real estate because of a fear of a crash. Which the cardinal sin is that you never buy real estate based on appreciation, but you buy it based on its ability to cash flow sustainably. Now, with that said, it is important that you get involved, whether it's with someone else passively or doing the deal yourself, in a manner that is safe. For example, one of the things you want to make sure you have is financing that's secured in the deal that's fixed and long-term, especially right now. In fact, a lot of banks who are currently financing apartments and development projects are currently pushing for loans that restructure within the next 5 to 3 years. Now, here's why banks do this and how it could potentially hurt you. So it's no secret that interest rates have been at record lows the last 2 to 3 years. And well, banks kind of don't like that because the way they make money is that they borrow our money at a very low cost to them, and then they lend out that money at a much higher cost to us. And during a time when rates are super low, they try to structure loans where the rates actually change within a span of 3 to 5 years, knowing that full well the possibility of the rate being higher at that time is pretty good. Now, here's how that could potentially really hurt us. So let's say you buy a rental property that cash flows $500 a month, with the remaining terms of the deal appearing right here on the screen. And let's say in 3 years you restructure your loan and the rate increases to what the rate is at that time in the market, which is 5.5% instead of 4%, which would decrease your cash flow by $150 a month, lowering your total return by as much as 30%. Now imagine that same scenario, but instead with a 300-unit apartment building deal that involved multiple investors putting in millions of dollars, every single one of them expecting a certain yield of return on their investment. At that point, you can see how things can get a little messy. This is why, in my opinion, if you're gonna get involved with real estate, which the wealthy tend to do a lot, I would seriously take a look at deals that include secured fixed rate long-term financing, which we've already talked about, deals that cash flow within the first 30 days, and deals that are in areas and markets that haven't seen unrealistic and unsustainable rental growth the last 2-3 years. AKA, if the rents go back down from what they've gone up the last 2-3 years, I want to make sure that the deal is still okay. And considering there's a good amount of competition out there, that's why I'm personally being extremely selective with the deals I look at for my investors. Now, with that said, let's move on to our third and final point in terms of what the wealthy tend to do right before an economic crash, which is that they tend to diversify into assets that they know will come back up in value. A prime example of this would be commodities. Now, this word has been shuffled around a little bit more the last 2-3 years, considering that we now have digital commodity. But let me make this really short and simple for you guys. When it comes to diversifying into commodities, what I'm personally investing into are things that I know for sure are going to be worth the same thing, if not more, in 10 years. Now, obviously, this isn't investment or financial advice. I'm not a licensed professional, but some good examples might be Bitcoin and other stable cryptocurrencies, gold, precious metals, and even assets that tend to appreciate with age. Now, with all that said, let me be very clear about something. At the end of the day, if you follow all the financial fundamentals, such as having an emergency fund, living below your means, budgeting, dedicating portions of your regular income towards saving and investments, and also looking at different options of cash flow, not just focusing on long-term accumulation, an economic recession or even a crash shouldn't affect you significantly. It typically affects only those who went against those fundamentals and made poor financial decisions, such as purchasing unnecessary luxury items as opposed to buying into investment vehicles, aka the people who spend the money they don't have to buy the things they don't need to impress the people they really don't even like. Now, with that said, earlier in this video, I shared one of the most important things to do right before a crash is to pay off debt, and that straight cash isn't always the best route to go. Well, my brother Sam actually made a video on how to pay off the biggest debt the average American household will have, which is the mortgage. And the strategies shown in this video have helped thousands of families pay off their debt in almost a third of the time without having to make more money. And for your convenience, we're gonna put that video in the end screen right here. So with that said, guys, don't forget to like this video, subscribe to our YouTube channel, and until next time, I'll see you guys in the next one.